We're seeing a bit of calm here in markets. The MSCI Asia Pacific benchmark back to pre-Brexit levels, but we still see a lot of uncertainty. What does this all mean? How long could it last?
Well, I think the challenge here is that no one really knows how long this Brexit process is going to take. How does UK, or what model will UK choose to pursue this Brexit? And meanwhile, life goes on. So I think if you look at, for example, during the Brexit market volatility, oil price was relatively stable. That to us indicate that the economy or the market is not as concerned about the global economic impact as the stock prices or the currency market are suggesting. And to us, at the same time, there's a reliance on central banks coming to the rescue time and again. This time around, Mark Carney is supposed to speak this week. I think that's going to be crucial in setting the tone of what the market would expect when it comes to central banks doing more, cutting rates, printing money in order to keep growth going.
But you talk about oil being quite resilient amidst all this, but you continue to see bond yields head to record lows, especially in Japan, treasuries as well. I mean, you see defensive stocks really rallying, as well as gold really holding those gains. So what does that still paint? It's still a pretty conflicted picture that we're seeing right now.
Well, I think that's telling us the market is now expecting central banks to continue with its negative interest rate policy or the war on NIRP. And I think from that perspective, we expect the bond yield continue to drop lower. I mean, already about 3/4 of developed market government bonds are already in negative yield territory. And that will push more investors, especially institutional investors, to the riskier end of the bond market. And I think that will follow. So, you mentioned about defensive stocks, high dividend equities. I think that's, again, another way to play the low yield or negative yield environment. Ultimately, you have a growth environment that is not super constructive to earnings, so that's not great for equities, but it helps to put a floor on default rates, or to support companies not going to default. So that's a great environment for corporate debt. I think that's why investors are chasing into that market right now.
Yeah, you say that fall in bond yields, lowered rate expectations. Obviously, the focus has shifted back on dividends. What sectors are you looking at? Is it the banks? Is it property? Is it transport, energy?
Well, I think at the moment we're still looking at mainly on the defensive areas, the utilities, not so much the banks. I think the banks themselves are still going through a lot of pain, whether it's in Europe or in China, where the credit quality is still under question. But nonetheless, I think there are still some companies, especially in Asia, where they don't belong to the defensive sector, but they belong to the growth sector, but yet they're still coming up with pretty reliable, consistent, and respectable dividends. I mean, for example, Taiwan is a great example. So I think, while we're looking for dividends, it doesn't have to be defensive. It can potentially be cyclically sensitive, and this is where I think some of the opportunities are.
Is the hurt still going to be in the pound, I guess? Sterling, we're seeing a bounce back from those 30-year lows. But, I mean, some people are saying that the real money investors still really haven't even jumped back in to really trade this. So could it have further to fall?
Possibly, because ultimately, the UK is still running a very sizable current account deficits. And you do need currency to adjust to really address that issue. The question is, has the depreciation of the pound so far been able to address that issue, or do we need to see more? And at the same time, again, we mentioned Mark Carney just now, what's his position in terms of the central bank's policy? If he's going to be aggressive in supporting growth, then that may suggest that the pound has more to lose.
Okay, I want to switch to Australia because a lot of uncertainty in this election outcome as well. ANZ actually seeing the Kiwi and the Aussie dollar might actually reach parity, that this is a realistic possibility. Do you see this now that, reforms could be on hold given what's going on here in the government?
Well, I can't pretend to be an expert in Australia, but what we have seen in Australia is very similar to what we've seen across the Western democracies, where, the established parties are losing support, whereas some of the more not radical, but more liberal or, more nationalistic parties are gaining more support. And that's going to create a lot more challenges when it comes to reforms, as you rightly said, or implementations of fiscal policy. Again, what's going to happen? Central bankers are expected to come to the rescue. And that's where I think the currency market could reflect that possibility.
Oh, what we are seeing, though, with Aussie yields, I mean, as you mentioned, we are heading to record lows. But what does this mean for where they can go next? Because on the one side of this coin, you could say that yields could go up because of this credit rating is at risk here. But the other side, we see the RBA really coming to the rescue as well. So
I still think the risk to yield is on the downside because, we talked about just now where 3/4 of global yield is below 1%, 35% below zero, and Aussie bonds right now is still considered as high yield in the developed market government bond space. So there is a natural attraction for investors to move into that space. And at the same time, as you rightly said, the risk is for RBA to cut more. So I think, the risk of going forward is still for yield to move lower.